Bitcoin hasn't just pulled back, it has been unwinding, methodically, relentlessly, shedding more than 21% in November alone, from $110,000 at the start of the month to the mid 80,000s today. On the surface, it looks like a classic collapse in confidence. But what if it isn't? What if this sharp emotional flush isn't signaling weakness in Bitcoin, but stress building beneath the surface of the global economy itself? Because something about this sell off doesn't align with the usual story. Even after this drawdown, Bitcoin remains nearly 5 times higher than it was at the bottom of the FTX scandal, one of the largest frauds ever uncovered in financial history. Back then, panic was rational, trust was broken, the industry looked toxic, and yet sentiment today, despite a far stronger foundation, feels worse. The headlines are predictable. Crypto got everything it wanted. Now it's sinking. Analysts warn the slump may spread across financial markets. Commentators dust off familiar talking points about bubbles, mania, and misplaced faith. Whenever something goes wrong in the legacy system, Bitcoin is always the first to be blamed, but metrics tell a different story. Bitcoin's MVRV, a reliable long-term gauge of speculative excess, usually hits extreme highs near 5 at cycle tops. Right now, it sits a full standard deviation below its long-term trend line. That isn't the signature of a euphoric peak. It's the footprint of an asset being mispriced under emotional stress. The weekly RSI is sending the same signal. It has fallen to its lowest reading since January 2023, a level historically associated not with the end of a cycle, but with the beginning of multi-month accumulation phases, moments when patient capital buys while panicked investors flee. Meanwhile, in traditional markets, price action is becoming unhinged. Nvidia added $25 billion in market cap in a single candle, only to erase the entire move within hours. That isn't exuberance. That's liquidity fraying at the edges. And in Washington, something even more unexpected is happening. Lawmakers have introduced the Bitcoin for America Act, a bill that would allow U.S. citizens to pay federal taxes directly in Bitcoin with no capital gains tax. It goes further, proposing the creation of a strategic Bitcoin reserve for the United States. You don't introduce legislation like that when an asset is dying. You introduce it when the old monetary regime is losing integrity, when the system is fraying and you're reaching for something that still holds value through time. So the real question isn't why Bitcoin is dropping. It's why the broader system feels increasingly unstable. Why equity markets are behaving like they're held together by thin liquidity threads. Why political institutions are suddenly elevating Bitcoin rather than dismissing it. Why long-term valuation metrics point to strength while short-term sentiment collapses. What if Bitcoin isn't the failure signal at all? What if it's the alarm and everything around it is what's starting to break? To answer that, we turn to someone who has warned about this moment for years. Macro strategist Luke Groman, whose polycrisis thesis may explain why Bitcoin is flashing red while policymakers insist everything is fine. When Luke Groman warns that everything is coming together at once, he isn't being dramatic. He's describing a system that looks stable on the surface, but is quietly buckling underneath. And at the center of his thesis is a brutal numerical reality. The United States is spending 96% of all federal tax revenue on just 3 things: interest payments, entitlement programs, and veterans benefits. 96%. That means the world's largest economy is operating with almost no fiscal buffer. If tax receipts slow even slightly, if unemployment ticks higher, if corporate earnings dip, if growth softens, interest costs will surpass 100% of revenue. At that point, policymakers face only 2 options: default or print. And for decades, they've always chosen the printer. But the fiscal math is only one piece of the machinery that's grinding under strain. Another pressure point is the Treasury market itself. In 2013, the US government rolled about $100 billion per week in short-term T-bills. Today, it's rolling $550 billion every single week, more than 5 times as much. This isn't routine refinancing. It's a liquidity fire hose pulling capital out of every corner of the financial system. To sustain this pace, the Treasury must keep a larger balance in its general account, the TGA. But raising the TGA drains liquidity from overnight funding markets, the same markets that nearly broke in 2019 when repo rates spiked without warning. We're seeing early signs of that stress again. And then there's Japan, the canary in the global carry trade coal mine. Japanese 10-year yields are sitting at their highest levels in years, yet the yen is weakening sharply. A rising yield combined with a falling currency is classic emerging market behaviors, not what you expect from the world's third largest economy. Why does this matter? Because for more than 30 years, the yen has been one of the two major funding currencies for global carry trades. The other is the US dollar. Whenever the yen gets too strong, the carry trade blows up. Whenever it gets too weak, the dollar carry trade blows up. Either way, liquidity evaporates. And the US is now 30 months into a massive shift toward issuing more short-term debt because foreign and domestic buyers alike are demanding less of the long-dated stuff. That shift is the cornerstone of Groman's Red Queen problem. The Treasury must run faster and faster just to stay in the same place. But the cracks aren't only financial, they're physical, rooted in energy. U.S. shale production, which drove 90% of global supply growth over the past decade, is rolling over. The EIA is warning that drillers must accelerate output just to keep production flat. Meanwhile, the IEA has quietly admitted that their earlier predictions of peak oil demand were wrong. Demand is rising, not falling. A world that needs more energy is suddenly producing less. Layer onto that a geopolitical landscape that's shifting in ways the dollar system hasn't fully priced in. Russia has effectively outlasted NATO's expectations in Ukraine. Whether analysts like it or not, that outcome carries implications for the perceived ability of U.S. military power to backstop the dollar's reserve status. Foreign governments see it. Bond markets feel it. Liquidity senses it. And while equities continue to float on momentum, Bitcoin, an asset with no circuit breakers, no bailouts, and no political protection, reacts instantly. It is the only major financial asset that reflects liquidity stress in real time, which leads to a question that viewers rarely get asked in traditional finance. If Bitcoin is the smoke alarm, what do you think is actually catching fire beneath the surface? Your thoughts below. This is where your perspective matters. Because the deeper we dig into Groman's thesis, the clearer the pattern becomes. This isn't a Bitcoin story, it's a liquidity story, and it's just beginning. The most dangerous stress point in Luke Groman's thesis isn't the fiscal math, and it isn't even the Treasury rollover. It's the collision between AI and the US Treasury, a trillion-dollar liquidity war that almost no one is talking about. Artificial intelligence needs capital on a scale we haven't seen since the Industrial Revolution. Trillions for chips, trillions for power, trillions for data centers, and trillions more for the infrastructure needed to feed those machines. At the exact same moment, the US government also needs trillions, not for growth, not for innovation, but simply to roll over its exploding short-term debt. Two titanic entities, one shrinking pool of global liquidity, both reaching for the same dollars at the same time. So what happens? Rates rise, liquidity tightens, and every fragile structure in global finance becomes more fragile still. But the irony is what makes this collision truly dangerous. If AI succeeds, if it does what it promises and replaces millions of white-collar jobs, then tax revenue collapses. And when tax revenue collapses, the Treasury needs even more money. More short-term bills, more rollovers, more borrowing at precisely the moment when global liquidity is already running dry. That's the snake eating its tail, Groman describes. A feedback loop where success creates fragility, and fragility forces more borrowing, and more borrowing accelerates the liquidity drain. And this is before adding the other pressure points. A massive Treasury rollover schedule that grows heavier with each passing quarter. Rising geopolitical risk, the kind that tests alliances, energy flows, and reserve currency assumptions. Energy scarcity as shale rolls over and global demand rises instead of falls. Foreign governments backing away from long-dated U.S. debt at the worst possible time. One by one, these stresses converge, and in a liquidity-fragile system, the weakest structural points crack first. But here's the twist. Bitcoin is not the weakest point. It's simply the most honest one. It trades 24/7. It has no circuit breakers. It doesn't get bailed out. It doesn't halt. It doesn't freeze. It doesn't hide stress behind policy language or optimistic press conferences. It reflects liquidity reality instantly, often weeks or months before other markets are forced to acknowledge it. This is exactly what happened in March 2020. Bitcoin collapsed to under $4,000, not because it was failing, but because every market on Earth was failing at the same time. Then came the response, the single largest flood of liquidity in modern financial history. Stimulus, QE, direct support, bailouts, backstops everywhere. And what happened next? Bitcoin didn't just recover, it exploded from $4,000 to $70,000 in just 12 months, the fastest major asset revaluation ever recorded. There was a sequence then, there is a sequence now. Pain first, liquidity second, Bitcoin third. And today, as we move toward 2026, every major macro indicator is pointing toward the same destination: massive fiscal stress, rising geopolitical uncertainty, funding market tremors, an unprecedented AI capital vacuum, a new, likely dovish Fed chair taking power in May, a politically volatile midterm election cycle in November. Every piece leads to one conclusion: a new liquidity wave is coming. And when it hits, Bitcoin, the asset that gets punished first when liquidity dries up, is historically the one that responds fastest when liquidity returns. That's why the current drawdown is not the end of the story. It's the prelude, the calm before the reversal, the darkness before the ignition. The part in the movie where the audience thinks the hero has fallen, only to watch him rise with more momentum than ever, because cycles don't break, they repeat. When the dust settles, narratives fall away and only the mechanics remain. Bitcoin isn't falling because it's defective. It's falling because the system around it is straining, and Bitcoin by design is the first asset to register that strain. This has always been its nature, a fixed supply instrument floating in a sea of expanding obligations, a 24/7 mark-to-market asset in a world of delayed disclosures, a liquidity seismograph that vibrates the moment funding pressures rise. And because it reacts early, it also recovers early. Look back across the cycles. In 2012, Bitcoin sold off as Europe wrestled with sovereign debt. Then liquidity returned, Bitcoin surged. In 2016, as China burned through reserves defending the yuan, Bitcoin cracked first, then rallied. In 2020, a global liquidity panic crushed every market on Earth. Bitcoin bottomed early, snapped upward with breathtaking force, and led the world into a year of historic asset inflation. And now, as we approach 2026, with fiscal dominance entrenched, geopolitical commitments stretched thin, short-term debt rolling over at record pace, AI absorbing unprecedented amounts of capital, and a likely dovish Federal Reserve chair stepping in, the pattern is repeating. A liquidity wave is building. It's not here yet. But in every major cycle, political incentives eventually force the same response. When the cost of maintaining the system becomes greater than the cost of printing money, they print. When funding markets tighten to a breaking point, they print. When elections approach and economic pain becomes politically unacceptable, they print. History doesn't just rhyme, it maintains a rhythm, and Bitcoin has learned to move with that rhythm better than any asset in modern finance. That's why long-term investors don't view this drawdown as capitulation. They view it as positioning, a recalibration before expansion, a Bitcoin Black Friday, the kind of moment that feels terrifying in real time but becomes obvious in hindsight. Because here's the truth. You don't get infinite liquidity chasing 21 million fixed units without volatility. You don't get structural revaluation without periods that shake out the impatient. And you don't get asymmetric opportunity without moments that look like disaster to everyone else. Which brings us to the real question, the one that will separate those who merely watch markets from those who actually understand them. When the next liquidity wave hits, will you recognize it soon enough to act? Because if history has taught us anything, it's that the people who thrive through systemic resets are the ones who learn to read the early signals, not the headlines that arrive months later. If you want to stay ahead of those signals, to understand the cycles before they break into the mainstream, and to navigate the next phase with clarity instead of fear, then make sure you're here for the next chapter. This story isn't ending, it's accelerating.